Hey there. It's only been a few weeks since we took a look at the debate around an AI bubble in financial markets. But honestly, there's just so much more to discuss. The investment we're seeing in new semiconductor chips and data centers is getting bigger and bigger. AI's impact on the economy is deepening, and its role in national security is growing. So where's this all going? And if it is a bubble, what does that mean for the economy? Let's try and find out. I'm Carmel Crimmins, and this is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. On this week's show, the debate around an AI bubble, Part 2. So to get into all of this, I spoke with our very own Mike Dolan. He's editor-at-large for finance and markets at Reuters, and you might remember him from the last time we covered this topic. Mike Dolan, hello.
Hello, Carmel.
It's wonderful to be here with you in London.
Yeah, it's strange to have you over. Nice to have you in person.
It's nice to be here. So we talked relatively recently about the debate around an AI bubble, but Mike, there's so much more to talk about. We felt we had to get you on again, right? Because it feels like it's all anyone can talk about when it comes to the global economy, the US economy. And looking at the US economy, which of course we all do, it's in a funny place right now, isn't it?
Well, it's a very funny place in the sense that we don't really know what's going on. We've had the longest government shutdown in history. Been a long time since we've seen any update of economic data. We got a little glimpse of inflation numbers for September, but that's about it.
Right.
So we're pretty much reliant on lots of private sector cuts and surveys and so on. But when last we knew, the GDP, annualized GDP in the States was running around 4%. And so for all of the near heart attack we had in April and all the forecasts of recession and
fears around the Trump tariffs
and all of that disruption that that was prevalent really hasn't materialized, at least not up until the point at which we lost data. But we would have known, I think the Fed officials are very open about this, that, had there been a major turn since the government shut down, it would be clear from other cuts of data and other things that they look at, kind of alternative data.
Right. I mean, in terms of US GDP, we actually don't know how the economy did in the third quarter. We haven't had data for that. But it seems that people in the market seem to think that the AI boom is helping to prop things up, is helping the economy to motor along in the US.
Yeah, it's a big factor, but it's very complicated this year. I think for the first half of the year, the rough estimate that people have been working with is that something like 2/3 of that 1.6% expansion averaged over those 2 quarters was AI related in some shape or form. There are questions about that. The first half of the year was very distorted, largely for international trade reasons because of the tariffs.
People scrambling to import. Right.
Yeah, absolutely. And there was a huge front loading of that in Q1, which led to a contraction of GDP. So strange kind of GDP maths that kind of got all mixed up. There is a point being made that a lot of that import rush made it look like a heavy amount of AI spending was going on because it was imported computers and other things.
Which were exempted from the tariffs, right, in order to keep that AI boom booming.
Absolutely. So I think, that raises a question. So it might not be quite the 2/3 of the first half growth that we thought, but either way, I think most people can read fairly clearly that it's a big factor in construction, certainly on data centers. It's
corporate investment.
On what's happening with the stock market and the stock market in its own right. If you're looking at consumer spending, which is held up in the first half as well, it is a big factor in that. The wealth effects of people who suddenly see their stock portfolios rising sharply or recovering, as the case may be in the first half, suddenly feel emboldened to buy again to some degree.
It feels like there's a bifurcation in the economy. You've got the AI boom boosting stock market, making people who have stocks in their portfolio feel wealthy, encouraging them to spend. But then you have a whole host of people who maybe don't have that kind of income, who are still struggling with the cost of living crisis, right? And maybe struggling to find a job if they don't have one, right? We have this kind of, we've had the no hire, no fire sort of economy, right? So there is this interesting bifurcation.
It's very true. And I think there are lots of aspects of the economy that just don't add up completely. I would say, on aggregate, consumption has been okay this year. And so, the US is driven by consumption.
Yes, 2/3 of the, But is that consumption driven by wealthy people? I mean, there was a very interesting stat, came up actually in one of the previous pods. I think Moody's said that the top 10% by income account for nearly 50% of consumer spending.
Close on that.
I mean, that is extraordinary. So It could be that consumer spending is trotting along quite nicely due to a small portion of people who have stock portfolios.
Almost certainly, but that has been the case for 20 or 30 years. And it's the aggregate that really people watch and monitor every month. It's what the markets look at, it's what investment looks at. And if, as you say, which is very true, the top 10, 20% of income earners do the lion's share of retail, then that's almost certainly the case. And they're also, of course, the stock holders also. Right. So that's not to say there isn't stress and problems at the lower end of the income scale. There probably is. I mean, you can see during the government shutdown alone, with the absence of food aid, how much damage that can do to people's lives. But that won't register on GDP or macro data. Maybe it should, but it doesn't.
And that really hammers home, doesn't it, the kind of the risk, the recession risk, if this is an AI bubble and if it does burst, sort of the impact on demand in the economy.
Yeah, I think you can look at it different ways. I mean, AI may well be the future. I mean, it may well be the economy of the future. So what the market is trying to price is essentially where we'll all be. I mean, look at the difference. If we go back to the dot-com bubble, and it was a bubble, but it is the economy that we ended up in. What is it that you do that doesn't involve an iPhone or a smartphone of some sort, or involve the internet and digital world to boot? So that was a bet on the future, and it did transpire. If AI is equivalent to that, then this is going to be the economy, whether you're rich, poor, or otherwise, that everyone lives and works in and operates on. So if that is the future of the economy, and bear in mind that AI is something that we've riffed on for 2 years now, with ever since the ChatGPT arrival in 2023. But people are now talking very clearly about quantum computing, right, as the next big kind of tech wave. Even the Trump administration is talking about taking stakes in some of those startups and companies. And quantum computing, again, if you believe the acolytes, could totally transform the way we operate within the digital world. It certainly changes the entire infrastructure that we've been used to. So there are big things happening. I was looking at a very good piece of research from Société Générale during the week, and they were just doing some number crunches, but they looked at what the AI boom stocks really are. And they were looking at 63 stocks. Now, that's about 50 more than I was thinking of. But it's quite a broader range of companies than you might think when you look at the Magnificent Seven or the 2 or 3 mega caps. So I guess that's also people's bet on the economy as this starts to be rolled out and starts to affect different sectors, from legal to media, all sorts of logistics companies. Yeah. And you can see with Amazon themselves developing their own AI capabilities, that sort of area is bound to become part of the economy that we live in.
And of course, Amazon recently said they were going to axe 14,000 roles, and they did cite AI as one of the reasons for that. Are we beginning to see the labor market impact of AI?
Be nice to be able to see anything from the labor market. We will get actually something today, this month, a little glimpse this month of some private sector numbers. But it is a question that has been around for some time. Can you possibly have 4% growth and 0 jobs? Right. So is that the AI economy? Right.
That's it. Are we in the AI economy? Yes.
Potentially, yeah. I mean, certainly there is, it wasn't just Amazon. I think there were a number of other big job cuts announced as well. Maybe they're not all related to AI. Mm-hmm. What you look at from an economics point of view is the productivity boost that goes with that. And
that's the golden aspect. In theory, for the cheerleaders of AI, it's the productivity gains. That's what drives economic growth.
Absolutely. Right? So basically you get more output per worker. Yeah. I guess people will look historically at any tech innovation for the last 200 or 300 years and say there was always fears that automating anything from steam engines to electricity to whatever that we've seen, big quantum leaps in technology, would always make people redundant, and it hasn't, because in effect, it boosted the economy more broadly and has created other jobs. So there's a sort of creative destruction going on, and that is again a hope at this point. I think we're in the early stages of that.
I mean, this is all happening right now in Donald Trump's economy. And, one of the big kind of mega trends this year in the US economy, we've had tariffs, of course, but is also the crackdown on immigration. And in a way, that's having a massive impact, isn't it, on the US labor market? I mean, there are less people coming into the US, which means that it's shrinking the labor supply, right? So in a way, that unemployment rate it's not leaping up perhaps the way one might expect. There's less people to be employed.
Absolutely,
right?
Yeah. And I guess it's the flip side, you could argue, of AI, right? So if there's fewer workers, which inevitably, if you
he's kind of working with the vision. I mean, I don't think that was on purpose, but there is a sort of a blending there, isn't there? There's less workers, and then AI coming in and boosting output. Allegedly.
It is really fascinating, though, isn't it?
Yeah.
Because if you think of this as the kind of great playbook of the reordered world of Trump, that's a world of balkanized economies that are much more dependent on themselves. There's much less movement of people and trade because you've got protectionism, and it's America first, but then is it Japan first? Is it China first? Is it Europe first? And if that happens, then do you also need less workers? If AI is a future for everybody, then is that also one that starts to see barriers go up to people coming in? In the US context, yeah, absolutely right. The numbers are actually stark, the extent to which immigration has been halted virtually completely.
Yeah.
But also there's a net outflow of people through deportations. And compared to what we were seeing in recent years, that's a dramatic turnaround. So people talk about what's called a break-even rate. What is that amount of new jobs that can be created without changing the unemployment rate? And they reckon that the monthly break-even rate for payrolls now is below 50,000. Some estimates are as low as 25,000, 30,000. So that means that the US only needs to create 30,000 jobs to match the available workforce. And that would have been as high as 170,000 this time last year.
Okay, quiz time. A lot of banks failed during the 2008 financial crisis, but one of the first lenders to go was Lehman Brothers. At the time of its collapse in September 2008, Lehman Brothers was one of the biggest banks in the United States and a Wall Street stalwart. But it wasn't founded in New York. So in which US state was Lehman Brothers founded back in 1850? Was it A, Alabama, B, Pennsylvania, or C, Massachusetts? We'll have the answer for you at the end of the show. Up next, how the AI investment boom is changing the US economy. Mike, since we last spoke, we've had tech earnings. And one of the aspects of the rally that we had seen, which was different maybe from the dot-com era, was that it's being led by a small group of companies that have strong balance sheets, big cash piles. They're financially they're pretty well armed to deal with this AI arms race. But we are seeing more leverage coming in, aren't we? We are seeing these tech companies going to the debt markets to fund what they're doing.
Yeah, I've seen the beginnings of it, as we spoke about maybe in the previous episode on this. That is one of the big arguments as to why this is not a bubble in the same way.
Right.
These are very profitable companies, at least the ones doing all this massive spending in infrastructure and capacity. And they are cash rich and they're using their cash. And we talked a lot about Mark Zuckerberg's famous, now famous quote, which he says he's quite happy to misspend a couple of $100 billion rather than miss the whole trend. But
it's a very expensive form of FOMO, isn't it?
It's a lot. But, Zuckerberg's comment reminds us all of Chuck Prince's famous line on Citigroup taking part in the credit boom in 2007. Of course, his phrase at the time was that as long as the music's playing, you got to get up and dance.
Got to keep dancing.
So it does remind you a little bit of that. If you're making decisions based on keeping tabs on your competitors, then is that the wisest way to spend a couple of $100 billion? But it is Meta who are borrowing, interestingly, and they're borrowing partly to fund this gigantic data center in rural Louisiana, a thing called Hyperion, that will be the size of a major city. This is an enormous undertaking, and the $30 billion or so in a joint venture with Blue Owl Capital is what that's about. Now, these companies are able to afford this, and they're able to raise this debt quite easily. Alphabet raised $20 billion this month as well. The question is, does that come out somewhere else? And there is an interesting story around that for the broader economy, which is that the big borrower on capital markets, the big kind of user of all this investment capital, has been government. So that's an interesting thing to watch. Maybe not one for this quarter or next, but certainly going forward, that does change the sort of economy that we've seen for the last 15 years.
I mean, that's a concept in economics called crowding out, right? You're crowding out. So are we seeing that in other aspects of the economy? I mean, yes, you could be potentially crowding out Uncle Sam, but you're also crowding out other companies, other sectors, maybe beyond AI, who are looking for investments, who are looking for capital for various projects, who maybe aren't getting it because the market is so focused on AI. Are we seeing that? Is crowding out happening in other senses as well?
It could be the case. I mean, the real issue with crowding out is just makes everything more expensive, right? And I would say the interesting idea of crowding out comes usually that government starts to crowd out its corporate sector.
Right.
This one may well be that some
reverse.
very, very highly rated companies, which are probably as highly rated as the US government at the moment, may well be starting to crowd out and muscle in on the turf that Treasury would want for itself. So the cost of borrowing for Treasury goes up. And as you know, not just since Trump's second term, long before that, since the pandemic, certainly, the worries about the scale of debt accumulation in Treasury is something that everyone's had on their mind for some time. If this makes it more expensive, then does that add to the problem?
I think this year there's an estimate that something like $400 billion will have been spent on kind of AI capital expenditure. It's a huge amount of money. And obviously it needs ultimately to yield a return. So I suppose the question becomes, how much do these tech companies need to earn in order to justify that type of capex? So an estimate from Bain saying that it could require $2 trillion by 2030, like $2 trillion. And I was checking back to see, what has OpenAI earned in terms of revenue, say this year. First half of this year, we're talking $4.3 billion. So that's a vast disparity. I mean, is that something that investors are worrying about, or are they just sort of parking those fears and just buying the dream?
There's a lot of big numbers being thrown out there, and there's a lot of kind of futurology that is barely knowable, I think, at this point. I think their calculation right now is you simply have to be part of this, because if you're not and you're left behind, it will be more devastating for any sustainability of your business model in that tech space. But it's a big risk, and that's why people worry about bubbles. If that return doesn't come through to match that sort of spend, have you just burned about $1.5 trillion cash?
Yes.
That's gone. And if you're borrowing the rest, it's one thing betting cash on the future. It's another thing borrowing for it. You're in a different place altogether. It really does have to work then. And if you look this month at what there's nervousness on Wall Street, not because of any trigger, not because of any shock, but just that the valuations have just gone stratospheric.
Yes.
And one of the leading lights this time round is a company called Palantir, which you may be familiar with. It's been the darling of everyone because it combines defense with AI. So it kind of has its fingers in all the pies that are trendy at the moment. And its valuation, as of now, is 230 times forward earnings. Its stock has quadrupled.
That's .com levels.
It is, absolutely. So the question has to be, do you deliver? And if you deliver eventually, maybe so. But does the stock price hold that?
I hope you're enjoying the show. If you like listening to Mike, why not read what he has to say too? Mike is a columnist at Reuters Open Interest, a one-stop shop on Reuters.com and the Reuters app for financial analysis and commentary. One aspect of, and we spoke about this on the previous show, about the TMT.com bubble, was a lot of fiber optic cable was laid. It lay dormant for a long time, but then it did get utilized as the internet economy took off. Would the same thing happen with the AI economy? You know, we're seeing these vast data centers. You mentioned the one that Meta wants to build in Louisiana, these huge hubs. I mean, will they become white elephants if this thing doesn't work, or can they be utilized as the fiber optic cable ultimately was?
It's a good point. And I would say that one of the things about fiber optic back in the day was that as the dot-com bubble burst, that actually using that became super cheap. Compared to what was being priced originally as it was being built. So not only did it have that infrastructure that was durable and usable going forward, it became much cheaper than it had been in the late 90s. And I suppose maybe there is something there as well from an inflation point of view and from a price point of view and a margins point of view from companies. But you're right, the build out of these data centers could well be that similar infrastructure, because the scale of them is extraordinary. It's not just building more buildings. It's the scale and the computing and the power with them. And also power is a huge factor of this boom and investment boom. I think BlackRock have been advising this for some time, that you're buying AI stocks, but you're also buying energy stocks because of the amount of energy needed. And there's all discussion of small nuclear reactors attached to these data centers to create the sort of power that's necessary. So that sort of investment, even if AI didn't deliver the sort of business returns immediately that everyone hopes it will, that sort of infrastructure is going to be available. That's for sure. And then for other things.
For something. Exactly. I mean, because the other issue, of course, is, and obviously it's a very expensive part of the whole equation, is you've got the data centers, but then you've got the chips that go into them. And my understanding is they become obsolete pretty quickly as well, right? You're sort of constantly innovating on the tech as well. So it's not like it can hang around for a long time to be used for other purposes. You sort of have to move quickly with it.
Absolutely. And I would add more as well. We talk an awful lot about Wall Street's bubble, right? Because all of this is concentrated so much in US tech companies who have dominated the space in everything to do with tech for 20 years, right? Certainly over the last 10, 15. And those last 10, 15 years, prior to the pandemic at least, were years of great globalization and free trade and alliances between countries. That's a different world now. So if the US is developing, and we saw this in some of the big outages in recent weeks with AWS and Azure, the Microsoft, and these are the big international global cloud providers. In a world that's worried about national security, in a world that's worried about exposure and supply chains, it seems inconceivable the rest of the world will look at the world that Trump is creating in that regard and say we rely on US tech for everything we do. So my point simply is that this tech development, whatever's happening on Wall Street, will have to be replicated elsewhere.
In other countries.
China's already doing it. We know that. It's developing its own ecosystem in tech that's not reliant on chips from the States, which it doesn't believe it can rely on anymore. But Europe's going to have to do this as well. So, and the building of data centers, it's not going to be one big European data center. There's going to be a data center in Germany.
France, because there are those national security issues.
Of course.
So that's kind of a bull case, actually, right?
Absolutely.
No matter what's happening in the US, this stuff has to be built over this side of the pond.
Absolutely. And I think there's a global picture here. Now, we look at kind of things like JP Morgan's announcement of 1.5 trillion of America First investment over the next 10 years. And you can see this investment boom coming down the pike really, really on a vast scale. But multiply that across the world, Germany's spending €1 trillion on defense and infrastructure spending. How much of that will be technology? There's nothing in the defense world these days that won't involve technology. And if you are spending big to fight the wars of the future, then you're going to be spending big on things like AI and drones and other aspects of it. Far from a world that's getting into shock over being balkanized on trade and national security issues, there's an investment boom coming, not just on AI, but on a whole range of issues.
So do you mean that balkanization is kind of driving, it's driving investment because everything has to be sort of duplicated? It has to be, each country has to have its own?
Absolutely.
Right.
And you can see that in a globalized world, we can rely on Apple or Microsoft or some of the big, if the US is an open and friendly country, why not? Why go to the trouble of investing vast amounts of money in your own tech infrastructure when you can pull it off the shelf?
Yeah.
But it's a different world if there's not those same alliances, if there's not those same dependencies, if quite the opposite, if you get into major security issues with the hegemon, the world's biggest economy.
Yeah.
Certainly China feels that way and is thinking along those lines. And I'm sure that's not the only one. It may be a bit different in Europe, but maybe not that far away either. So it does create a world which the IMF told us only a few weeks ago in its annual meeting that despite all the worries, it forecasts 3% growth for the world economy this year and 3% next year.
Right.
Which on the surface isn't boom boom, but
No.
it's certainly reasonably stable
and eye-catching in a period when we've got so many sort of trade tensions.
Absolutely.
Right.
So trade is going to drop. If you believe the WTO, trade growth next year will be as low as 0.5%. It revised it down more than a percentage point in its latest update. So this is not about trade. So this is happening somewhere else, right? Yeah. And I think that's the point I would make. If we go into investment booms that are driven by international rivalries, defense, national security issues, they do involve tech, they do involve construction, they do involve energy, and they do involve all those things, but they'll be done at home, not necessarily. And a big question then I would kind of lead to is, does capital remain globally mobile in that environment, or does it also go home? And I think the incentive for governments to bring their own investment capital back and bring it to bear at home will be very, very high. You're already seeing a lot of that going on. And most of that capital has been invested in the United States over the past 15, 20 years. That's where it's gravitated towards. The big surplus countries of Germany, Japan, China, that's where the money's gone. If it's needed at home, does it get repatriated?
If you like this podcast, why not subscribe to the newsletter that accompanies it? Also called Reuters Econ World, it spotlights our best coverage of finance and economics, and it's published straight to your inbox every Thursday. We've put a link to the sign-up in the description of today's show. In the final part of this episode, we hear about what could happen if this is an AI bubble and it bursts. Mike, there's been two bubble bursts in the last few decades. We had the dot-com bubble, then we had the US housing bubble. And each of them were very dramatic. But in the case of the dot-com bubble, there was a recession, but it was pretty brief. It didn't last very long. Not so for the housing bubble bursting, right? That had massive repercussions in terms of recession globally. If this is a bubble, if it bursts, are we looking more at a kind of financial crisis, housing crisis type impact to the economy? What do you think? Would it be shallow? Will it be deep? If there was a recession?
I mean, this one to me at least, and looks much more like the late 90s, the dot-com.
Okay.
Because if you think about what happened in 2007, 2008, this was essentially a credit bubble.
Right.
And even though mortgages and housing were at the center of that, the reason it had such a devastating impact on the whole world was that it hobbled the banks.
Right.
And so the banks almost came to their knees. They actually did come to their knees. There was almost a collapse of the entire banking system simply because of the scale of lending that had been done into housing. What happened in 2000 was different. It was essentially caused a business recession or a business investment recession at the time, and didn't have as much impact on generalized consumption in the economy as we've talked about it early on. And one of the things that helped an awful lot at the time was the fact that the Fed was able to cut interest rates quite considerably into that downturn, and it boosted the housing market.
Right. Yeah.
So there is an argument that what went on after the dot-com bubble led to the subsequent one in credit.
Right.
But that's maybe another day's podcast.
Yeah. But it is interesting because as this AI investment, keeps going on, deepens, spreads to other countries, in terms of the funding for that, you're going to see more leverage, you're going to see more debt. Maybe it's from the banks, maybe it's from the shadow banking sector, right? So the private credit. And if, the sums are to be believed, if trillions are needed, that doesn't it raise the risk of, systemic financial risks, like systemic issues, if you've got a lot of leverage spread across the global economy, which was what happened in the financial crisis.
Yeah, it's true. The leverage aspect is worrying. There's no doubt. It does create a different picture as to how. But you could also make the argument that it then becomes too big to fail.
Right. Well, I mean, and to that point, if it is a bubble, if it does burst, we've spoken before about, who could come to the rescue, and the US government is not in a fiscally healthy state to help. So it would likely fall to the Fed, right? So cutting interest rates, perhaps. That can then just sort of further fan the flames, right?
Yeah, but I think, first stage is first. The US government, I think in particular, and as we suggested, probably the case around the world too. But if
true, not just a US problem, that's true.
If you look at the Trump administration's approach to this, it sees technology and the chip sector and AI and quantum computing all as essentially part of its great reindustrialization of the America,
right,
of this America First idea. And it believes that, government is integrally involved in it. It's taken stakes in Intel. Correct. It is taking stakes in these quantum computing firms, or at least that's reportedly prepared to do that. And it's talking openly. This is industrial policy par excellence, right? This is return to the 70s. And even though we saw a lot of that post-pandemic, even from the Biden administration, this has gone up another gear again. And so this is now a government issue. It's not just the private sector punting away on some newfangled toys in the corner that may or may not fail. This is now being integrally built into the system at large. And if governments are investing to that degree in this, the idea that AI disappears in a puff of smoke just isn't conceivable.
Right. This is the Pentagon, not pets.com. And so therefore, it would be a brave person then to bet against it, because you're effectively betting against the US government.
Well, you can bet against the stock valuations. And Michael Berry this month, famous for his big short on the credit bubble, is doing that against Palantir and Nvidia, as it happens. Now, he's been wrong many times in the interim, but it shows you that some investors think this is a time to short the stock. But that's different from whether AI emerges as a usable, dominant technology. And I think you can have both.
Mike, thank you so much for your time.
You're welcome.
A big thank you to Mike for his time and insights. You can catch all of our great economic coverage on Reuters.com and the Reuters app. Now for that quiz. I asked you to name the US state where Lehman Brothers Bank was founded back in 1850. Was it A, Alabama, B, Pennsylvania, or C, Massachusetts? And the answer is Alabama, in the state capital of Montgomery to be exact. It was initially started by Henry Lehman, a German immigrant, but his brothers Emanuel and Meyer joined shortly after, hence the name. The business started as a dry goods store before moving into cotton trading and then finally to finance at the American Civil War. Its failure in 2008 was the biggest bankruptcy in US history. This is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, please drop us a line in the comments section of your favourite podcast platform. You can also reach out to me on LinkedIn. This episode was produced by Ethan Plotkin and Eliza Davis-Beard. Sound design, music composition and engineering was by Josh Summer. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our daily show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.